You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome to the show, Bob.
Yeah, good morning, Jim, and good to be with you.
You say the shine is off the U.S. dollar right now.
Yeah, that was perplexing to the establishment that the U.S. dollar would be up. And for all these multi-decades, they've been teaching us that for any real risk or perceived risk or even slight worry, the remedy is always the same: depreciate the U.S. dollar. This, of course, by the Federal Reserve. And they had intermediary steps on this. You know, it was never really that we're going to depreciate the dollar. We're going to provide stimulus. We're going to provide QE or whatever. Anyways, it virtually started when the Fed opened the doors for business in 1914, and the dollar is depreciated right down to 3%. But there are times when the policymakers can't depreciate the dollar at will, and that was during the 1930s contraction. And it has been the case during this post-bubble contraction, post the bubble that blew out in 2007. And we note that throughout the last 300 years of history, that in a post-bubble contraction, one of the features is that the senior currency becomes chronically strong against most other currencies and most commodities for most of the time. So there's nothing new going on. But at any rate, we had the really good rush and rally in the U.S. dollar index right up to 100 in November and into early December, when the crude oil was getting hit pretty hard, and then it corrected back to the 97 level, and then it went up, and 3 times it tried to get through that 100 level, and it couldn't make it. So last week we were wondering, when you get some of these things, try 3 times, and then it doesn't work, maybe it's going to fail. Well, it did drop down. I thought it might find support at 97, which is the 200-day moving average, but it's down into the 96 level. But looking at this, maybe there's support at 95. It's been quick. It's like only, a week here to crack it down like that. And of course, this has popped up gold and silver. It's popped up the base metals, and it's popped up crude oil. So, but these things were oversold. And then you have a nice seasonality for crude oil for a low down into January sometime, and then a relief rally perhaps into March. And then on copper, you can have seasonal weakness into November, December, and then a seasonal recovery maybe into March. Now, what happened with the attempt by copper to set a low in November, of course, was taken out when they got really serious about taking down the price of crude oil. And so now we're getting the relief rally. It has been choppy, and it will continue to be choppy because it's a very volatile market, and volatility is telling us that there's not much depth to any of these things, and just doesn't take much to really push a price quite a ways when you've got a thin market. But anyways, it's relief, and it could last into March. We had been talking since November about kind of an opportunity in here that we called the rotation, whereby some of the commodities that were industrial commodities like base metals and energy prices that were kind of beat up going into the year-end thing, that you can get that seasonal relief. So it looks like we're, and also the stocks related to the XLE or the oil patch stocks and XME, the base metal miners, they've all, and the gold stocks have had terrific rallies. So it's kind of more or less on schedule, and as we noted, looking good perhaps into March. So long as it's been brilliant, but so long as it just doesn't get any more excessive than it is now, we'd sooner see some swings on stair-stepping up into March, but as I said, the markets are volatile. And then going with this, we had looked for weakness in the financial stocks, the banking stocks, and in the U.S. you got the broker-dealer index. And yes, they indeed get weak. And then saw a note recently here that in October there was a survey of what the large cap fund managers were doing, and their favorite group was the financial stocks, and which have got hammered here. And sometimes it's worth looking over your shoulder, and we're looking back to July when our technical work on the bank stocks, and also related to the yield curve, which either favors or disfavors the banking business, and also credit spreads. And so that was, in June we saw the credit spread starting to widen, and you saw a tentative move on the yield curve turning away from steepening. So then that was some other things we decided it was time to get out of the financial stocks, and that's where we dragged out our line about, it looked like a good, safe, short positions for widows and orphans. So, yeah, it's been a good position. So, so I don't see any huge rally for the financial sector, maybe a bit of a rally, but the action swung over to some of the industrial-based metal miners and oil patch, that sort of thing. So, and then on the gold sector, again, a pause in the advance in the U.S. dollar has given refreshment to the gold bugs, whose only way of looking at gold is to say that the Fed is evil, it'll depreciate, and the gold will go to 10,000. But we've never worked on that premise. Instead, we've used history. And the big plus here for the gold sector is that the price of crude oil just plunged relative to gold. It's a huge decline. And although gold in U.S. dollar terms was going down, crude oil was going down much faster. So crude relative to commodities has been performing well and recently made new highs for the move. And our case is that when you have cheaper oil prices and falling relative to whatever you're getting for the bullion price, your costs of mining are improving. So your margins are improving. So we continue to look at the gold sector where the gold itself you would hold for insurance, and but the gold stocks are where the investors would look at for improving operating margins and cash flows and all those analytical things. But typically in a post-bubble contraction, 1930s or the 1880s, the gold sector has done well in a post-bubble deflation, and we continue to advise people to look at it from an investment point of view rather than just straight the bullion side. So, in December, on the first dip, we advised accumulating some stocks, and then early in January got the big explosive move up, and then some of them went all the way back down to where they started. But a couple of weeks ago, we said there'd be another opportunity on the downside for the gold stocks, and that one would accumulate again or add to your position, which we have done. And now, some of them up 40%, so it's been a pretty good move. So that's the easy part is in, and the next part will be kind of choppy.
Bob, we have a question from Frank de Beer in Belgium. And his question is, GoPro, also known as camera on a stick, is down 85% from its peak. DDD, the famous 3D printing company, is down 93% from its peak. Is this the kind of decline something you see possible for the big indexes as the credit cycle unwinds?
Yeah, boy, that's the key question. That kind of action we saw in 1929 with Radio Corp of America, RCA, way up and then all the way back to where it started. Then move ahead to 2000 when, for example, Cisco, actually you want to go back to 1720 with the South Sea Company. That stock was well quoted, and it was one of those things. So you can overlay the South Sea Company in 1720 with RCA in 1920, and just pick any one of them in 2000. Cisco is one that we've used. And now you've got the GoPro and there's other ones. It's interesting that the bigger market, like the NASDAQ, did not come down proportionally with it. Because when, for example, Radio Corp failed in 1929, it was with the whole market. And also when Cisco failed in 2000, it was with the whole market. So there's a little bit of a distinctiveness going on here. It's showing what extremely popular stocks can do. And now we want to make another distinction here that in 1929, when RCA collapsed along with the rest of the market, and the S&P fell something like 85%, that was when New York market was a lesser market than London. London was the financial capital, and their index of stocks only fell in half. So then we move ahead to 2007 and 2008 crash. Well, the S&P, if I recall rightly, fell 48%. And other lesser stock indexes did the 80 or 85% crash. So, yes, you can get these stocks like GoPro falling to giving up 85%, but I think on the next bear market in the U.S. with the S&P, that 48% or 50% decline would be in line for a mature stock market, and various extremely formerly hot sectors can do the whole 85% thing. Actually, that was a good question.
And he has a follow-up question as well, Bob. And that question is, once the post-bubble decline accelerates, what do you think is going to be the flight to safety, bonds or cash or gold?
It would be cash and gold, because for, decades now, maybe more, on each setback in the stock market, the game to play has been the long end of the bond market. But in the bond market, there are two types of risk. One is credit quality risk, where there is doubt that you'd get your interest or even your principal, so that's serious risk. And then for like long-dated treasuries or government of Canada's, and these sovereign bonds, there's not much doubt about getting the interest payments, but there is price risk where I think so. The game of running into long treasuries on a setback in the stock market has been very good. We have played it, and we lately have just been playing the long end of the bond market from oversold, which it was at 116 a while ago on the TLT, and now it's up to 130, whereas in January last year it got up to 135 and was very, very overbought. So what we're saying here is that the game of buying long treasuries against a decline in the stock market has been successfully played a number of times. And our case is that it may not do it yet again. So we're at 130 now on the TLT. Previous high was 135. I think the best is in here on that. So it's time to be prudent.
Well, of course, GoPro was a darling, a high-tech company. And, of course, we've seen other crashes where people get really attracted to high-tech. 2000 was probably the best example of that.
Yeah. We live in interesting times, huge volatility, and a lot, now, individual private participants in the market, either brokers, individuals, corporations, financial people, can get pretty speculative on their own. But what you've had here is that the central bank's policies have become highly speculative, very aggressive, even to the point of belligerence, because they have a theory that they can manage the world. It's not looking so good lately, so here they are. They're motivated by two things. One, they really think they can make things better, and then the other one is not not talked about at all. It is that they are out to try and prove their theories are right, that you can depreciate currency and you get GDP out of it, and the market is beginning to condemn this. So we live in interesting times, and we think it's ending action for central bankers. A recession comes in here now, and then they're going to look like fools for having all these QEs and being hugely aggressive. And they're wagering the taxpayers' money, you know. It's absolutely absurd. The central bank has been hopeless. They're doing nobody's a favor by allowing the currency to depreciate so severely. Look, for example, since 2008, crude oil has come from 147 down to 27. So in order to make this a positive for Canada, they depreciate the Canadian dollar by the same amount. That's not going to help anybody. Fooling around with interest rates and depreciating the Canadian dollar, it doesn't help anybody over a period of time. It may help some exporters, but then it penalizes importers and it penalizes savers. It's an evil policy. Well, we're going to leave you for the weekend.
I was going to say our trade deficit is still over $500 million. So I don't see how it's helping much there.
No, it won't. Currency depreciation is an evil, and at some point the public will figure it out.
Bob, have a great weekend.
Jim, thank you so much. It's always fun, and we look forward to talking to you next week.
My guest has been Bob Hoye, market historian and chief investment strategist at institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. And if you have any questions for Bob or comments about the show, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.